Spain's government formally asked for billions in aid from the European Union to bail out its banks this morning. Arch rivals Sony and Panasonic agreed to form an alliance to develop next-generation flat-panel TVs. I'm Lindsey Bell, and the morning call starts right now.
Good morning, I'm Scott Redler, Chief Strategic Officer of T3Live.com.
And I'm Lindsey Bell with The Street, and together we bring you the morning call. Stock futures this morning are pointing to a down open. Spain this morning came out and they said that they are officially asking the EU for bailout money for their banks. Italian banks are going the same way. We've got the EU summit coming up at the end of the week. What are your thoughts on all of this?
I think coming in today with the futures down 10 handles, we're opening right near the Thursday-Friday support. So I think most traders probably coming in relatively flat, saying, you know what, last week we had a very potent down day on Thursday. Need to see where that leads to. So a lot more, a lot of guys cleaned up positions. Some are actually probably shorted Friday's bounce because it was somewhat feeble. And now in the next day or so, bulls are going to be tested. The rally went from, a confirmed uptrend, which typically fails in June, July, back to rally under pressure on Thursday. So right there, you're supposed to put yourself back on your heels a little bit. And if you did so, you're coming in today, and there could be some opportunity versus if you got caught in tier 2 or tier 3 longs, which no one in this community should be that deep or be that committed.
You warned us last week on Wednesday, I was here with you, that we should, take some profits there, that there could be downside. So what levels should we be looking at going into this week, and how are you going to trade?
Well, going into Wednesday, the oscillator was plus 75. So I don't care how healthy a market you are. If you're overbought and you're plus 75 on my oscillator, it's time to sell. And you better get some really good news out of the market, not just hopes on stimulus, hope on coordinated central bank levels, but it really was just, if you look at the chart, let me show you where we came back to. If you guys remember, this head and shoulders top, the left shoulder, the head, the right shoulder, which gave us a nice coordinated move all the way down to, where we hit the lows. This was that, break through the 200-day, come back above, moved to right here, the beginning of the right shoulder, and then this right shoulder built, showing some commitment to this move off the lows. And we talked about measuring the depth. This was about 30 handles. So first target of this move was about 30 handles, which took you right to 1360, which took you right to a retest of the neckline of the head and shoulders top. A lot of head and shoulders going on here. So if you took some stock off, or you took profits, or you hedged your portfolio, or even got short, this was a great spot after a 100 handle move off the lows. So now, Friday had a little bit of a bounce back, nothing so big. Typically you want to see the market take back at least half to negate the strength of this down move. It couldn't do it, and we're opening right below it or near it. So here you have 1324. If we can't get above this in the first 30 to 60 minutes, I do think that this lower level is going to be tested. And this is really where the bulls need to make a stand. And I actually think if we get down to this area, I think a lot of people are going to lose faith, and the testing the lows chance are going to start coming out.
It looks like we're shaping up to have a pretty choppy summer this year as well. What has June and July looked like over the past few years?
Typically that May to end of August, September time frame is very choppy. But if you're a short-term tactical trader, there are these 8 to 10% moves both up and down, or 5 to 7% moves both up and down. And I went over this, I think, a month ago, saying, well, listen, we're only in June. Don't chase highs, don't short bottoms, because if you look here at the chart, let me just show you a little bit of what went on prior. So this is where we are now. Look what happened back here. Look what happened last summer. Last summer, once this head and shoulders pattern actually triggered, you had to move down to about 1100, and then you had 1, 2, 3, 4, 5, 6, 7, 8, 9 moves basically in the same range before it finally went to the upside. You had one little overthrow to the downside, but literally you could have made a lot of money in this area. If you go back to the summer before then, okay, to see what kind of ranges happened, and we'll take you right back here because I just like to show you why you don't have to chase anything. Look at this range, okay? Same type of scenario. You could draw a line across the top and then basically across the bottom. Besides, look at that, one overshoot. We came down to about 1040. Came up, down, this was your peak. If you bought this, you were in trouble. This time you had a little follow through to the downside, came back up, back down. So then finally, September through October it went. So you're talking about big ranges here where you can tactically take percentages out, where if there's a 7-8% range to the upside and the downside, don't be there for the bottom. take out a few percentage points in the middle, be safe, do the high percentage trade, and then move on. Don't chase tops, don't chase bottoms. Just look for the best A+ setup and sit on your hands, because sometimes if you overtrade, you'll put yourself in a hole.
So remain active. But
yes, active.
So getting into the sector spotlight, we're going to talk about the banks, because on Thursday night, late night, we saw that Moody's downgraded 15 of the big banks, which was widely expected, but it wasn't as bad as many people had expected. So we saw some of the broader indexes like the BKX go up 1.3% on Friday. A lot of the other banks had a bounce on that day as well.
Well, the banks came off the lows and they helped the rally off the lows. The rally really ignited actually when JP Morgan said, their loss is $4.2 billion versus the $2 billion, and that's when it reversed. And we actually targeted watching that, say, listen, if JP Morgan is bought in the news, that's going to help some type of move off the lows. And then finally, there was chatter all day that Moody's was coming out, so they scared the out of everybody. And then it wasn't as bad as people thought. If you look here at the XLF, you will see that from this low, that that was, I guess, a tradable bottom, because you had your nice 2-day move into what was a sideways consolidation as it showed some commitment off the lows. Then you had to move back to resistance. Here was a resistance. This was higher resistance. This is where it turned tail. I do think if you sold some into resistance, you probably could retest or rebuy back around 14, 13.87. You can't chase the banks because I don't think they're going to have any extended moves. It just might not be that much of a headwind. And if you look at JP Morgan, we just talked about that. This was the day that they announced the $4.2 billion. So it was almost like sell the news of what that loss could be, and then when they announced it, you bought it right here. Then they also said that they covered 70% of it. So on JP Morgan, I think if it pulls back, this would be an area to watch, 34.73. If you have a lot of upper level commitment, that's a spot to potentially buy. And if that doesn't hold, I would think that for this to be healthy, and this would probably mute some of the downside action in the market if it holds above 34. But again, going sideways here is good. It's in front of the gap. Next time any momentum will come in, I don't think it's going to be for a while, and that's right around 37.
Morgan Stanley was a stock that people had really been watching for this downgrade. Some people thought it could be downgraded by 3 notches, but was only down by 2. So that was good news for the stock, but it only traded up about in line with the broader group. You've been avoiding this one for most of the year. Is this still an avoid?
As an investment, I think it's an avoid. Sometimes there's trades in there. The pattern is tight, so it could go either way from down here. If you look at the chart, you will see that there are 2 patterns. You now have a defined resistance here. You have 1450. This high here is 1446. This high here is 1444. So really 1440 to 1450 is clear, defined resistance. So a lot of people are short this thing. If it trades through, you get yourself a nice trade. It could be good, but I don't think that happens. I think that within this move to perhaps test the lows in the market, if it were to break this small little uptrend here, which is very, very small, starts trading below, just say 1380. Your next level here of support is down at 13, and then the lows. So as this range gets tighter, guys will probably be shorting it below 1380, and then if it stays in here while the market corrects, then that 1450 will be the next action area to watch.
Citigroup's another stock. Their chart looks a lot like the Morgan Stanley chart. They are actually at their lowest rating now since the company was formed in 1998 with the merger of Travelers. So what about this stock?
This stock, I feel like they've done a better job staying out of the news lately. They haven't been in the fire zone, but it's still just bouncing around. It's bouncing around a little bit better than Morgan Stanley. If you look here, you will see that the move off the lows actually had a little bit more girth to it. It came back to almost this moving average. But I do think this also, it looks really ugly to me. You have this little uptrend, that it's been trying to ride after the move off the lows. It's an ascending channel. If it starts to break back below this, just say like 2750, I think you're going to see people bail. And then it's just the same way I showed you the support on Morgan. This is big support on Citigroup. I don't like what I see here, but it's a little bit better than Morgan. Obviously, 2 different businesses.
Right. Bank of America was up 1.5% on Friday. It's holding above its 50-day moving average. So is this one that we could maybe be more bullish on, be long?
This one I actually been trading more than the Citigroup and even the Morgan Stanley. It seems to have decent bounces. You just have to take a lot of size here. If you look at Bank of America, they also haven't really been in the news as a firestorm, as doing anything crazy wrong. Obviously, when they bought Countrywide and the whole debacle way back when. I like it because it trades by patterns. I guess there's a lot of algos in here. Look at this last tight pattern that we made a lot of money on when it traded to the upside here, and then it consolidated near the highs but couldn't go anymore and then broke below. And then look at this. Okay, this was the first potent up day, off of this low area. Then it went sideways, and I know I targeted this for a small little trade when it broke above this little wedge here, above 770, and hit the moving average. I think you could probably buy this thing back to 750. If it doesn't hold 750, then it's just going to try and drip and drab all the way back down to lower levels, 720, and then the recent lows here. But this is something I hate to say I feel a bit more safe, and hopefully this isn't a sound bite later on, but I feel like you're safer with Bank of America versus Morgan Stanley.
That's interesting. How about Goldman Sachs? That stock was one of the only banks down on Friday when the other banks got a little bit of boost.
First of all, the timing, I think, is horrendous. I think that they've lost a lot of credibility. If you're watching this even from Goldman, I'm sorry, you probably don't come out with your equity calls anyway. They said generational buy at 14.15. 2 days later, we corrected, and then they gave a sell signal at 12.80, and we bounced back to 13.63. Great job. Anyway, the stock itself that used to be a great trading vehicle has been so out of play and so leaned on. I think it's still an avoid. And I look at the weekly chart. I think if we're going to go lower, this stock's in trouble. If you take a quick look here, you will see this is the daily, and you didn't see much of a rally at all. Okay, you saw a move from maybe, 90.55 back to the high here of 97. Percentage-wise, not big at all. It's created, to me, it looks like more of a bear flag where, it came down, consolidating near the lows. If this thing starts getting below 92 and breaks below 90.50, I think you have a move into the low 80s, high 70s. You go to the weekly chart on Goldman Sachs, you take a more of a macro look, and it really doesn't look good at all. And there's nothing much underneath it, too. If it starts breaking this weekly support here, which is pretty big, you could see a move down to, you have 80, but really the next key level here is into 76. So Goldman Sachs, if they did something wrong that hasn't come out yet, like a big whale type trade, this stock could be 76, and that's not going to be good for the banks.
That won't be good at all. We're going to take a quick commercial break, though, and get into a quick look at some earnings and some tech stocks, so stay tuned.
Hi, I'm Sean Hendelman, CEO of T3 Live, where we train, coach, and mentor traders in order to help you put your money to work with confidence. The T3 Live approach is a blueprint for you to recognize, adapt, and ultimately take advantage of different market conditions. To begin your training with T3 Live, we would like to offer you the opportunity to enroll in our free 30-day online home study course. Fill in your name and email address, and I'll see you on the other side.
Last week we started to get into some earnings reports. It's been a little bit of a mixed review, and right now pre-announcements to the negative side are outweighing those to the positive side, 3.5 to 1. So it's really going to be probably a story of the haves and the have-nots. I
think this is going to be a very volatile earnings season. I think when the situation really started getting worse in Europe in like April, May, I think a lot of wallets will probably close. I think even on the consumer side, because it was so in the news everywhere. But anyway, I think there's going to be more downside action versus upside action, but some will be priced in and some won't. So you better know what you're holding, when they're reporting, what your position is, what your time frame is, and whether you should be hedged or how committed you actually are. I think the first thing you wanted to talk about was
FedEx. They missed their numbers last week. They cut their forecast, and on the day of earnings, the stock was up. But I think if you look at the chart, it really hasn't done too much this year.
Well, this one, you want to see what happens. And I know when it came out, everyone was disappointed, but the stock acted fine. So maybe forward looking, it's in a better position. So if you look here at the chart, you will see that it's still holding higher. Day of earnings, it actually, if you take a closer look, gave you a nice, actually this is the weekly, it gave you a nice igniting bar. So here it is. That's what I think we wrote that day. Went above this 88, 89, went to, into pierced through a resistance a little higher. It's trying to flag. If you're in this stock and you're uncommitted, I think that if it gives way to 89, you get out of the way. It's probably just going to come back into the base. If it were to hold this area and go sideways and the market wanted to turn up at some point, this doesn't have much resistance up until 95 or so, but I'm not going to trade this. I'm going to avoid this. I just think you're lucky that you didn't get slammed on that bad report if you're a long-term holder.
Another bad report was out of Bed Bath & Beyond. Sales were weak. There was margin compression there. The stock was hit 17% the day after it reported earnings. I think Wednesday night and Thursday was down 17%. What do you see in this chart? Is it buyable way down here?
Well, if you weren't in the mess, sometimes someone obviously trashes your treasure. We know that whole setup, and there wasn't really that many signs here, to be honest, because you figure Bed Bath & Beyond, it's not that expensive. People love it. Who knows? It's not like a high end, blah blah blah. So if you look at the chart, you will see that it was actually trading a bit better. It was above the moving averages. It was following a decent type of trend here. So this really was a surprise. That's why when you have a big surprise, it's that damaging. So at this point, you have a big support down here at 58. Typically, I would think, a day or two after some type of surprise, you don't have to rush in. Usually it takes a few months to build some type of lower base. At least you do have a new point of reference. Your new point of reference here is 60 and a quarter, 60.25. So if you're trading short-term, trade it from there. But if it can't bounce and take back, at least half of this bar besides the gap, the downside pressure is going to persist, and then perhaps guys would look to short below this area for a move down to 58. I think it's just an avoid and let it sift itself out right now.
Darden Restaurants, the quarter, it was in line, but the 2013 outlook was well below the street. The stock actually acted okay though on the day. It was up, a little under 1%.
Yeah, this one wasn't a disaster, and it actually held support because it wasn't really pricing in much. So if you look here at the chart, you will see that it wasn't at the high end of the range. It was right smack in the middle. This chart looks to me like just like a choppy mess anyway. That's why I don't hear any of my traders talking about trading it. But as far as the actual action, earnings are out. It held longer term support, right there. So if you traded it that day, nice little area to buy against. I think if you're an investor, as long as it stays above this 48 area, you could stay with it. But if it doesn't get away from here soon, this could break and you could see lower prices. They might not have just wanted to tip their hand, on that day. So overall, if it breaks that area, here's your moving average coming in, and then really there's nothing until you could measure a point here, point here, point there. So short-term support, if it breaks this, I'd get out of the way.
Carnival Cruise Lines, the quarter was in line. They even raised guidance. The stock's been up about 11% so far this year. So what are the levels we should be watching going forward with this one?
So I don't really watch this one that closely. And you just said they reported, they raised guidance. So overall, it should have acted well. So let's take a quick look at the chart and see if it did. So if you go take a look here, you will see on the daily chart, Carnival Cruise Line. So it looks like they actually, when did this happen? It was in last
Friday. They reported Friday.
All right, so they reported Friday, and look what happened Friday. This doesn't look like a great response to a great report. So to me, that's somewhat of a sell signal. Obviously, it had a big move, before it, so maybe it was a little bit too much. So I would say, watch this 33. Anytime I ever see a breakout failure so quick, it typically leads to some type of lower prices. So, I don't like when stocks do this on earnings, so I would avoid it. And if you are in it, watch 33. 33 gives way, and then it's right back into this mess over here.
All right, let's go into some quick hits. Let's kick it off with Apple, a high beta name that we always keep a close eye on.
Well, Apple, last week I got a little excited when the market seemed like it was hanging in there that it would trade through 590. It failed. Some guys actually made money short. And then yesterday or Friday, it held again. So it's still following this trend here. This was when it held the 100-day, held again, held again. Today it's opening down $3 or so. The low of Friday was 575.42. So I would look to see if it could hold here again. This is something I'm going to look for cash flow today, see if it can go from negative to positive just for a trade, just to stay in this range. It's still one of the best stocks out there, technically acting the best, but there's not much momentum in this market. That's why it couldn't break above here. So if you can't break above there, at least you could buy the dip here. There's some trades. So 575 is pretty big though. If this thing starts to break below 575, 576, the 100-day isn't too far away, and that would pressure tech, and that would also bring us lower in most of the indices. Continuing
with tech, Facebook, that chart's been seeing some upside momentum.
Yeah, this one's been great. This one gave you the red dog reversal, right around 25.76. And then remember, I tweeted at 28.10. I'm like, yes, I'm taking this long. It's the first time going above the 10-day. It's clearing the descending channel here. And look where that was. Here's your red dog reversal. Here's where it cleared this minor lower pivot. Nice 2-day trade, went sideways, went again. A lot of people are saying it was the Russell rebalance that gave it this last little push because a lot of volume had to come in there. At this point, who knows? All I know is it's been a great trade ever since it broke above 28.10. following all the rules. You could even still be in here from the swing if that's you there, because it never violated if you put your stop in, and it also, never had a drastic down move. So at this point, if it could stay now above 32 and go sideways again, it could keep working higher. I wouldn't chase it up here just because I want to see how it responds today once that added buying is out of the way.
eBay, is there some digestion maybe needed there?
Yeah, let me see what happened Friday. I know that it had a nice breakout, and it somewhat retested it. You had a nice 2-day trade. If you were a momentum trader above this 4160, here's your 2 days. Came back, retested it, held in there really well. I think this stock acts well. It's one of the chosen ones. I know market's not really letting that much momentum, so it's actually really good that it gave it 2 days. For short-term active traders that are still long this, they're probably going to give it to this area, because if it breaks this, just say 4166, it could come in easily to the 4113 and then maybe even test down to 40. So active guys don't need to sit in it. Macro guys, stay. It looks good. There's no reason to get out of it. If it does hold that area, at some point, if the market gets better, it should go again. But obviously, we need to see the market grab some footing.
Well, those are the levels that we're looking at in the S&P today. Some of the sectors we're looking at, we're watching earnings, and some specific stocks that we like. So be sure to check in at the end of the day with Scott and the T3 Live team for the daily recap.